All right.
All right.
Hello, everyone.
Hey, everyone. We're going to do a brief update on interest rates. So we've had lots of calls and emails and texts about Jerome Powell's announcement for interest rates and want to serve our audience with what we think that means and kind of the conversations that we're having about how that might impact the coming year for real estate investing. Nothing formal tonight. We just have some notes in a Google Doc we're going to share. Again, if you're here live and you have any questions, drop those here. We'll put the recording in Facebook and those sorts of things. But obviously, potentially a big deal for real estate, for the economy, labor, all of those things. We have no crystal ball. We're not experts. We're experts in the sense that we're living and doing real estate every single day, but we're certainly not experts at the level of the Fed or anything like that. But I think we have some knowledge about real estate and interest rates, and wanted to share that with you guys.
Absolutely. So no crystal ball. About 9 months ago, we did a similar presentation to this one, or just a quick check-in with our investor group.
As part of our community hour.
Yeah, because Fannie Freddie changed their guidelines last January, or announced there would be a coming change that we accurately predicted would have an adverse impact on rates for 30-year fixed mortgages, conventional mortgages for investors. So Fannie Freddie changed those guidelines. We kind of expected that about 60 days after that, there'd be a huge spike in rates for investors. We expected those rates to then kind of stabilize and slowly come down over the next 6 months or so, and then potentially even be a little bit lower than they were at that time as secondary players entered the market to kind of take the place of the spot that Fannie and Freddie had filled as Fannie and Freddie stepped back from backing mortgages for investors. And that is almost, to the T exactly what did end up happening. So I think, some of this stuff is pure guessing. It is truly a crystal ball kind of thing. Other things, I think it can be predicted, and we're not geniuses or anything. We just follow people who are much smarter than ourselves, and follow many different people who are much smarter than ourselves, and look for quorum and consensus in those projections or opinions. And then the nice thing is the Fed does tell you what's going to happen. There's an expression in the interest rate world, which is never bet against the Fed, because they have the ability to just prove themselves right at will. So we're just going to talk a little bit about kind of what the Fed has predicted.
I think the first thing to remember is we wanted to make sure we're here and talking with you and sharing this video, because we're getting a lot of calls about this and a lot of questions about this. But in general, the market behaves, I won't say independently from interest rates, but it's not as closely linked as some people think that it might be, particularly when the bumps are a little bit up and down. So like we just closed like a little over $7 million loan today. And between the time we started the paperwork and ended, it was like 60 or 90 days. And like interest rates have, fluctuated quite a bit. The deal would have been a deal kind of regardless of when we, had started that process. There's a pacing to it and that's what the Fed wants, right? They don't ever want for today interest rates are 3% and tomorrow they're 5%. That would have, very devastating consequences to the economy, and even vice versa, to go from 5 to 3. So it's slow and steady. So it's not as big of a deal as it might seem in the moment. Like when that happened this past year, we had again similar number of questions, emails, and really the single family business stayed pretty steady through 2021. Even with the changes, there was still a great deal of market appreciation, rental appreciation, homes sold. So there wasn't this, there was a thought of, interest rates are going up for investors, there will be no investment opportunities, or this is going to kind of completely halt the market, and that just didn't happen.
Yeah, the market tends to over anticipate the scale of and the impact of rate changes. One other thing that's really important to call out is that this rate change is not going to fix inflation. And I think that the Fed knows that. I don't think that it has any illusion that this 7% consumer price index number that just came out here earlier this week is going to be ameliorated by increasing interest rates. I think that they had to make a statement that they are on top of things, and
they're watching.
They're watching, yeah. But there's still a line out the door of cargo containers trying to get in the port of Los Angeles. There's still all sorts of market disruptions as a result of COVID that are going to continue for 12 to 24 months, and that's the real source of inflation right now. So in real estate, we're heavily impacted by interest rates. We're also heavily impacted by inflation. Higher interest rates are bad for real estate. High inflation is a good thing for real estate, especially if it's leveraged. So high inflation, it's not a good thing for the economy, but it is kind of a good thing for real estate. Quantitatively here, getting really specific, how high will rates go? So that's
before you get into that, before you get into numbers, I want to talk about what we talked about at lunch, which is there's a lot of messaging from the federal government right now that the shelves are full. You're going to have food for your Thanksgiving table. You're going to have presents for your holiday celebrations. I mean, literally, if you follow Joe Biden on Facebook, probably 20% of his posts are some sort of reassuring message to families that there will be things for you during this time of celebration at the end of the year. So there's a whole lot more going into inflation than just interest rates. I think the Fed needs to do what they can, or at least signal what they are responsible for. But what we were talking about is, the housing crisis. If you've been to some of our other presentations, you've heard us say, kind of the 5-second spiel is, in the last decade, fewer houses were built than in any decade in the last 100 years, even though clearly the population is much bigger than it was in, say, 1950. So there's still so much demand for housing that, we really feel like, if interest rates go up, what that's supposed to do for real estate prices is drive them down, right? That's how that's supposed to work. But there's so much demand, both on the purchase side and on the rental side, that we actually think that it will just drive up the price even more. And particularly in multifamily, where renters still need a place to live, people who own those assets still need to make a profit. Otherwise, they wouldn't invest in those assets. So it will just drive up the rental rate even more, because the owner is not going to say, oh, I'm just going to, or the potential owner is not going to say, I'll just purchase this, but it won't cash flow. I'm okay with that. They'll say, oh, I'll purchase this and I just need to push rent even higher. And so we were saying, like, I wonder if this is actually going to make inflation in terms of rental rate even higher. Again, who knows? Those were just some of the thoughts we were kicking around at lunch today.
Because if you think about it, by doing, it's called forward guidance. That's what the Fed has done by saying, here's what we are thinking about doing in the future. They've essentially lit a fuse here where they've said interest rates are going to go up as much as 2 points over the next 2 years. And to a typical home buyer and many investors who don't quite follow the numbers, to them that means, oh, I better buy right now while interest rates are low. And so we've already seen a huge imbalance in supply and demand, and I wouldn't be surprised if this creates an even bigger imbalance in supply and demand in the real estate sector. So how high will rates go and how quickly? So first of all, the taper needs to end before they start raising rates. So taper, or the quantitative easing, bond buying, whatever you want to call it, that's like putting your foot on the gas pedal of capitalism, so to speak. That's what the Fed's doing, is they're buying mortgage-backed securities, which synthetically lowers the mortgage rate for like a 30-year fixed mortgage, buying U.S. Treasuries that synthetically lowers the interest rate the U.S. government has to pay on its debts and other bonds, and just injects cash into the economy in a really powerful synthetic way. So they need to take their foot off the gas before they start applying the brake, which is raising interest rates. So they basically said, we're going to double the speed at which we are taking our foot off the gas, and then at some point after that, we're going to start putting our foot on the brake. So a nice kind of gradual thing. Depending on the response to that, that will affect how quickly they raise rates. So who knows how likely it is that this is how things will play out? But the Fed has said this is kind of our plan, and you don't bet against the Fed. It could be, though, that when they really start aggressively tapering on their bond buying program, there's economic consequences from that cause them to not put their foot on the gas or stop tapering. But we expect that interest rates could be as much as like 1% for the Fed rate by the end of 2022. It's 0% now, so 1% higher by the end of next year, and then about another point higher than that by the following year. Now, what does that actually mean to anyone that's listening to this message? An important thing to understand is that the Fed rate does not necessarily equal your interest rate on a home loan. So if you're buying a 30-year fixed, conventional mortgage, a Fannie Freddie mortgage, or some other product like that, that has a lot more to do with things like the 10-year treasury rate or a 30-year mortgage rate. So I'm going to do a quick screen share here. And so this is just a website called Y Charts that I really like. Just has a bunch of random charts here. So you can see here's a 30-year mortgage rate in the last 3 years. And you can see it was up at 4.5% pre-COVID here. And then it came all the way down to 2.5%. And now it's back up to 3.1%. And you can contrast that with the Fed overnight rate, where, it was kind of up in the 2.5% range here pre-COVID, dropped down to 0%, and it's going to stay at 0%. And then again, might go up to 1% by the end of next year, 2% by the end of next year, by the following year. So it'd be still lower than it was in 2019. But you can see these charts aren't exactly specifically correlated.
Spend just 30 seconds describing what happened there on the overnight rate. Explain what an overnight rate is and then why. Obviously, that's March of 2020. That's when the World Health Organization declared that we were in a global pandemic. And obviously things changed.
That's right.
Right. Like you can look at that and a first grader would say like, that looks weird.
Yeah.
What happened there?
So there's a lot of things the Fed does to try to smooth out the cyclical nature of our economy and our fractional reserve banking system. So controlling the amount of money that's in circulation. Lots of ways to put money into circulation. One way is the Fed loaning money to banks, to where you go make a withdrawal from your checking account or something like that. And so by reducing those rates, that incentivizes banks to lend out money, which creates currency and puts money into the supply. A really interesting thing happened during COVID. Tons of money was pumped into the economy from all sorts of different sources: government stimulus programs, cheap money from the Fed, bond buying, and nobody spent it. The savings rate went off the chart, and they kept pumping more and more and more money into the economy. But because no one was spending it, there was no velocity.
There was so much uncertainty in families of maybe I need to keep this money. If they're in previous times when there had been, say, a $600 stimulus, you might have gone out and bought your kids some new bicycles or something, but people weren't willing to do that. They didn't know if they would have a job or if they would miss time off of school or work. And so they just held on to the money, and that created a cycle that the government maybe perhaps didn't quite predict.
Exactly. And by lowering interest rates, that made housing more affordable. People tend to buy a home based on a payment amount. Let's say they can spend $1,000 per month on their housing costs. So if the interest rate goes down, that increases the amount of money that they can spend. In a strange sort of way, housing is sort of a proxy for interest rate in that way. And if the interest rate goes up, that reduces the amount someone can spend, and that's a headwind for the value of housing. So housing was just about the only thing anyone was spending money on in the pandemic. Very low interest rates with tons of free liquidity means extraordinary appreciation in the real estate market. Is it a bubble? Probably not, just because of the fundamentals that Elaine mentioned, where there's way more demand than there is for supply. It's just a huge supply demand disconnect that's out there right now. But that's really how we got in the situation we're in right now, as people got all this money that they are now spending, by the way, on consumer goods, which is why CPI is so high while there's so much inflation right now. Again, it's a supply demand thing. In a couple of years, it will resolve itself, but it's only tangentially related to the Fed rate. And that's why the overarching message of what we're talking about tonight is this isn't that big of a deal. This is not going to probably change your real estate strategy. You should be aware of these things. You should be thinking about these things. You should educate yourself. But the apartment buildings that we closed on today, they were a deal when it was a 3.0% loan. They're still a deal when it was a 3.15% loan. Probably still be a deal at a 3.75% rate loan. So interest rate is a big deal, but not as big of a deal as most people make it out to be. And the announcement from the Fed today is also not as big of a deal as most people probably make it out to be. In fact, the rate that you pay on a 30-year mortgage or potentially a bank loan probably has far less to do with the Fed rate than it does with regulatory changes from the federal government or from Fannie Freddie or other changes that you may not necessarily know anything about or have any control over, like the 10-year treasury. So going back to our story from earlier this year, where there was a small regulatory change or policy change from Fannie Freddie, rates spiked 1.5%, day over day. And we're not seeing anything like that on the horizon here. If we think about price growth in real estate, we saw about 15 to 20% price growth or appreciation in 2021. That's clearly a
It was
completely
a very good year to
unsustainable-
own real estate.
It was a very good year for us to own real estate. Yeah, for anybody to own real estate. That's clearly unsustainable. I think it's easy to see we're in the slow season. Seasonally, this is typically the slow time of year. And then the Fed announced that interest rates go up. And so, oh, is there a coming crash in real estate, or should I wait to buy because there's going to be a discount on the horizon? It's possible, but I think it's unlikely. So, at this time, I don't really see any change to our personal strategy. We're always open to ideas about that. And one final kind of interesting idea that I'd throw out there is this announcement itself could be all the Fed actually needs to do. So merely by talking about raising interest rates, it may achieve the desired outcome, which is slowing down the economy. So if enough consumers hear that rates are going up 2%, never mind the fact that that's years in the future, that may motivate them to not go buy that toy for Christmas, thereby reducing demand, thereby reducing inflation, which is the real goal, to try to get that CPI number under control. And I'll finish by just going over a really brief pro forma. If you are wondering, kind of what the real impact of this is, let's just take a look at a concrete example. So this is a live deal that we're working on right this second. So with today's interest rate, if you got a 30-year fixed mortgage on this particular property with a 25% down conventional loan, you bought it for $235,000, had somewhat normal costs. You rented it for $1,650 a month, somewhere in that territory. You might end up with something like a 5.7% cash on cash rate of return and a 27% total annualized rate of return at a 3.5% interest rate. So this is the 3.5% interest rate on that 30-year fixed loan.
I'm going to put those in. You can keep talking.
Yeah.
I'm just going to put them in like yellow or something so that it's obvious what has changed here.
So then I just simulated, and this is a simple calculation anyone can do. I just simulated what if we went to 4% or 4.5% or 5%. And you can see there's a drag on our total annualized rate of return and our cash on cash rate of return. Our cash on cash rate of return is cut in half, quote unquote, going from the 3.5 number to the 5 number, which is probably a more extreme spread than I think we might see over the next 2 years. If we go from 3.5 to 4.5, I think that's about as far as this will go. In that chart that we showed of the 30-year mortgage rates, you can see the swing was even less than that, and I don't see us returning to pre-pandemic rates quite yet. So I mean it is an impact. It is absolutely a headwind, but it's not that big of a deal. If this property was a deal at 3.5%, it's certainly a deal at 4%. And probably a deal at 4.5%, which is really the worst I think things could possibly go for the foreseeable future.
Yeah, and certainly the way I think about it is, I would concur with Nick that, based on our investment criteria, these two are definitely a deal today, 3.5 or 4%. Let's say we are projecting that 4.5% in a year or 18 months. So we're starting our rental rate today at $1,650. And if we just multiply, so in our lease, it's very standard thing is a 3% rent escalation per year. So that's $50 per year. And again, that's only if someone per month. Yeah. But like
per month per year.
Yes. Thank you. And that's if someone stays, right? We want to reward that they're staying. We don't have to do a turnover, those sorts of things. If someone leaves and the market has really changed, like there's been 10% year over year rent growth. Sorry, our phones are going off. Rebecca's probably crying in her coffee because she's always telling us to turn our phones off when we're doing our live calls. I promise I'll try harder. It might be $100 to get a new tenant in. So let's say, okay. So let's say this is say 18 months from now. Again, your purchase price doesn't change, right? You've locked that in the day that you closed, but now your rental rate is $1,700. Then you're back to this 5.7, 4.6, 4.5. I would consider this to be within a margin of error, right? Are we really able to predict our maintenance costs down to the penny? Are we really able to predict CapEx down to the penny? No, they're all guesses. So anything here is what I would consider to be a margin of error. And then if we get up here at 5%, well, let's say that's 2 years out, and then our rent is $1,750. We're back to that place. Or by then there's been more than 3% rent growth, which is what we've seen in the last several years, particularly here in Rochester because of Destination Medical Center. So maybe by then we're at 1825. Or maybe back here, we listed at 1650, but we get someone that has a dog, right? So the numbers are all like, you see how quick you can kind of, so the way we analyze deals is you can, our pro forma is, readily available in our course now because so many people have asked for it. And at first we said, we really think you should create your own calculator because you need to know this calculator so well. And then eventually we did make it publicly available because what I think the most important thing of this calculator is that you can run 100 scenarios in 10 minutes and you can see, okay, if this happens, that's going to change and this is going to change, but you're going to find the mean. You're going to find it kind of intuitively. So that's how I think about rising interest rates, is that rents are going to go up with rising interest rates and it's all going to wash itself out.
Yeah. Great question here from one of our attendees. That's, I think, a spot on question for our business model, which is a BRRRR business model. So, okay.
Oh, Mark said we're sharing wrong. Is that what you fixed?
I fixed it, yeah.
Okay.
Okay. So
thanks, Mark.
Let's say we bought some rentals while interest rates were low, like 2.3%, and real estate prices keep going up. So we want to refinance those rentals and pull money out to buy more rentals. Now the interest rate quote is 4%. How do you balance that higher interest rate against the ability to generate infinite returns through the refinance? Excellent question.
Yeah, that's a good question.
I think you hit the nail on the head right there, which is, can you get to an infinite rate of return? So that's a scenario. It might take just a minute for me to run it. So I don't know if I want to do it live, but you can easily just kind of run a quick, pro forma analysis on what is my, total annualized rate of return today. What's my total annualized rate of return after doing a cash out refi? And your total annualized rate of return is going to go down if your interest rate goes up, but it's going to go up if your amount of money left in the deal goes down. So you can literally compare those two numbers side by side in probably less than 5 minutes. You can perform that calculation and instantly know, am I better off taking my money out of the deal or leaving it into the deal? And then this is a situation where doing what's called an internal rate of return is potentially valuable. However, I think that's maybe an overly complicated way to analyze it, because you can simply assume that you could probably achieve a similar rate of return on purchasing a different real estate asset if you pull that money out and go put it in a different asset. So let's say before the cash out refi, you're at a 25% total annualized rate of return. After the refi, you have reduced your amount of money in the deal, but your interest rate has gone up, and now your total annualized rate of return is 30%. So it's gone from 25% to 30%. You have a higher total annualized rate of return. Your spread is small enough that I think the juice is probably not worth the squeeze. I think that just the loan closing costs and stuff would not quite make that make sense. At a minimum, I'd probably want to double my total annualized rate of return, go from a 25% to a 50% total annualized rate of return if I'm going to do a cash out refi event. That's just I guess a personal rule of thumb that I've developed over time. And I think that can give you a really quick decision as to whether or not that would make sense. For us personally, I would say that we tend to refi more aggressively. We tend to refi more quickly than most people, because that capital is so valuable to us to go get into another deal to start getting to an infinite rate of return in that next deal. There's an opportunity cost that we kind of factor in. So if there was an honest to goodness 25 to 30% spread, we might consider that, but I would want to see, ideally really like a 25% to a 50% spread before we would consider that. So hopefully that answers your question there. If anyone else has any questions, feel free to throw them in the chat. It looks like Elaine.
I'm trying.
Yeah, it's just complicated enough that I thought if we tried to do it live,
I feel like I'm in med school again.
Yeah.
Love it. Like when I was in I'm sure many of you guys in medical school, you'd have those 10-minute the fake patient encounters that you have to find the diagnosis and write the notes and all of that. I'm missing something.
So it looks like we're simulating a scenario here where we have achieved a full cash out refi.
Yeah. So, so that's what I tried to simulate. So this is, let's say, 3 years in the future. The property has appreciated, and I did the appreciation such that the appreciation gets you back your entire down payment. Again, these are a little fuzzy because I'm moving really quick here, but then there's $0 left in the deal. And you see that's because 285 times a 20% down payment. I'm assuming that it's like a commercial loan. A refi is often best accomplished through a commercial loan, not a conventional loan. So that's going to get us $57,000 back. Our rent has gone up because it's gone up as the market has gone up. I just quickly kind of moved some of these figures up to account for the increased cost as well. Vacancy management, those are percent, so those automatically calculated. We have a little amortization calculator right here, so we're able to run mortgage simulations very, very quickly. I did that there. So I put in our new mortgage payment, our new debt pay down, and then there's 1 penny left in the deal. So you can see here, this would, technically dip into negative cash flow, would be negative $40 per month. And that's why these numbers are so crazy, is because it's dividing by 1 penny. But let's say, so I would look at this, and depending on where I was in my real estate investing trajectory, I may say, you know what, I have a spare $50 a month to feed this property so that I can get $57,000 out. Other people may say, I have a hard and fast rule that it must cash flow. I'm not going to do this. But then I might be asking myself, is there something I can do? Can I paint it? Can I put some new cabinet pulls in? Can I change a couple light fixtures?
You potentially do that in advance of the refi to maximize the outcome of your refi.
Exactly.
Elaine and I have been in this exact situation countless times where we are coming up on a cash out refi event, and we'll do kind of a really light renovation in advance of that refi to try to stretch to get to cash flow neutral essentially. And then a couple of years after that, the property is back to cash flowing, and again we have no cash left in the deal.
Yeah. So I'd be asking myself, are there things I can do to improve this property, to remarket it, to really drive up that rental rate? And chances are, particularly in a growing area, the rental rate's going to have climbed past that anyway. So I look at that and I think, if I can get $57,000 back in exchange for an obligation of $50 per month, I'm probably going to make that trade. We would then take that $57,000 and put it into another investment. If someone is a little more on the secure side of the risk spectrum, let's do the math here. You now have $57,000 in the bank, and you owe the bank, the mortgager, $50 per month. You have 1,140 months of negative cash flow in the bank. Feels pretty secure to me. Of all of the refis we've ever done, we have never gotten to a cash flow negative situation. Will it happen? Probably, just as, because all these levers are changing at different times. But we've never run into this. But your question is spot on, because that kind of disrupts the business model and asks, like, what's the fastest I can get my money out? Maybe you say, you know what, the house is worth $285, but I absolutely will not go into negative cash flow. That's one of my core investment principles. It will not happen.
Which is a good one.
Which is a very good one. So I'm only going to lever it up to 270. So then we'll pop in over here, change our. And
you almost certainly get a discounted rate.
Yeah, because your LTV will be lower.
Yep. So very frequently you get like an okay rate at like an 80% LTV, and you get a drastically better rate at a 75% LTV. The 3 apartment buildings we closed on today, it was going to be close to a 4% interest rate at an 80% LTV. We got all the way down to 3.15 at a 75% LTV. I mean, that spread easily justified the additional 5% of LTV on that particular deal.
So we've left maybe, let's say, 6,000 in the deal. We're gonna call it that. See how there's 59,000 here. In this refi, we're gonna get 54,000 back.
Yep.
So now we're at $67 per month, which is great, right? Now the property is cash flowing, but you're at a 245% total annualized rate of return. The $67 doesn't change your life. That gets you, maybe most of the way to a dinner out once a month, but this changes your life. You've got your $54,000 back. You've left a small amount of money in the deal. You've got this little margin of safety here. And again, there's still margin of safety built into these other things. You're going to work hard to minimize your maintenance in a sensible way, right? You're not going to let things go, but you're going to work hard to minimize your maintenance. You're going to work hard to drive your rental rate up, those sorts of things, but you have all your money back. And you can do the next deal or leave it in the bank and have 1,000 months of the negative cash flow.
Great question on cash out refi. I think that probably wraps up our discussion. We're trying to keep it short here tonight. But thanks everyone for
Yeah,
joining
thank
us.
you.
Hopefully people enjoyed this quick format. Just wanted to get some certainty and some good news out to our group here, because a lot of questions have come up regarding interest rates. So
we'll put the replay in the Facebook group. We might send it out via an email too. You all have a good night, and I guess we probably won't be seeing most of you again. So Merry Christmas, Happy Holidays, Happy New Year. We'll see you again for Community Hour in January.
bye.
Bye, everyone.